Understand the factors to consider before putting your money in an ETF. ETFs are investment funds that invest in a basket of securities. These funds are listed on the stock exchange and are traded throughout the day. It is quite convenient to begin your ETF investment journey. All you need is a brokerage account, a demat account, and a savings account. You must always keep these considerations in mind before investing in an ETF. The major difference between a mutual fund and an ETF is the liquidity of investment offered by them. But an ETF can provide the desired liquidity only if it has good trading volumes. Therefore, it is always better to check the trading volumes of an ETF. An ETF is formed to track a specific sector, index, currency, or any other such asset. However, very often there are differences between the performance of the ETF and the asset it tracks. This difference is called a tracking error. You should always look for an ETF with a low tracking error. This will help you get returns that are in tandem with the market of the asset you wish to invest in. TER, or total expense ratio, is essentially the measure of the charges you need to pay for holding an ETF other than the brokerages and taxes levied on your transaction. TER is deducted from the returns offered to you by an ETF. Therefore, those with a low expense ratio yield better returns.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from HDFC Securities. To watch all the episodes, click on the link in description.